There is a stubborn myth in personal finance that investing is an exclusive club. We are conditioned to believe you need thousands of dollars in surplus cash just to get past the front door, and that without a massive lump sum, there is no point in even trying to enter the market. When most people look at a spare $100 bill, they do the mental math and conclude it simply isn't enough capital to generate wealth. The standard psychological reaction is to park that small amount in a traditional savings account, assuming it is better to keep the money secure until a larger, more serious amount of wealth materializes. The problem with leaving static money in a savings account is an invisible economic force called inflation. Inflation is the gradual increase in the price of goods and services, which means that every single year, the exact same amount of money buys fewer things than it did the year before. This graph illustrates exactly how inflation attacks cash over a 30-year timeline. The flat line across the top represents the physical $100 bill, while the descending line cuts straight through it, tracking the actual purchasing power of that money as it drops closer and closer to zero. While the digital number in your banking app will stubbornly stay at $100 decade after decade, the real-world value of that balance mathematically shrinks. You are holding the same piece of paper, but it effectively costs you money to hold it. This creates a deep irony for traditional savers. By strictly avoiding the market to keep cash safe from volatility, they actively participate in a system that guarantees financial decay. Playing it safe by hoarding small amounts of cash in a bank account is a dangerous trap. The only true financial safety comes from forcing your money to grow at a rate that outpaces the rising cost of living. Stepping out of that inflation trap requires a shift in strategy. It begins with taking that exact same $100 bill and deploying it directly into the market, where it can start working for you. The engine that drives this growth is compound interest. This is the process where the money you invest earns a return, and then those returns start earning their own returns, creating a snowball effect of wealth generation over time. Look at this chart comparing two different investment approaches. Curve A represents an investor who starts immediately with very small dollar amounts, resulting in a massive, sweeping exponential curve. Curve B represents an investor who waits 10 full years to begin, injecting much larger blocks of cash, yet failing to ever catch up to the trajectory of Curve A. The logic driving this gap is the compounding mechanism itself. Because compound interest relies on money multiplying upon its own previous growth, a tiny seed of $100 planted early mathematically overpowers a massive cash injection made decades later. Time in the market acts as a multiplier. It is an infinitely more powerful tool for building wealth than the sheer amount of starting capital a person happens to possess. The immediate practical barrier most beginners face is the price tag. It is difficult to see how you can buy into the stock market when a single share of a major successful company often costs hundreds or even thousands of dollars. The modern solution to this pricing barrier is a mechanism called fractional shares. Instead of being forced to buy one whole share of a company, brokerages now allow you to buy an exact dollar amount of that stock, effectively giving you a micro slice of the company based exactly on what you can afford. You can pair fractional shares with index funds and ETFs, or exchange-traded funds. These are foundational tools, prepackaged baskets that hold pieces of hundreds of different companies at once, providing diversification without the severe risk of trying to pick one winning stock. This visual demonstrates how the tools work together. A single $100 bill splits into dozens of fractional micro-investments, which then slot directly into a diversified ETF basket. You immediately own a fraction of the entire market. Warning tone. Before you start building this engine, you must establish a basic cash emergency fund. Life is entirely unpredictable, and having a small buffer of liquid cash ensures you never have to sell off your investments at a loss just to fix a broken transmission or pay a medical bill. The assembly process is highly streamlined. You simply choose a low-fee brokerage, open a basic investment account, link your bank to deposit your initial $100, and execute your first trade for a fractional share of an ETF. The modern financial system has removed the technical barriers that used to lock people out. Today, anyone with a smartphone and $100 possesses the means to own a productive slice of the global economy. The compounding engine depends on one variable that the market cannot control: the behavior of the person operating it. Even a perfectly diversified portfolio is vulnerable to the decisions made by the investor holding the phone. The most common beginner mistake is operating with a get-rich-quick mentality. New investors expect rapid, overnight profits and frequently try to aggressively time the market, attempting to guess the exact perfect day to buy or sell to maximize their returns. This mindset leads directly to panic selling. When the market experiences a routine dip and portfolio balances temporarily flash red in their apps, beginners instinctively sabotage their long-term growth by selling off their assets at a loss to stop the pain. It is incredibly easy to abandon a boring, diversified strategy when your screen is cluttered with plummeting charts, chaotic social media alerts, and rocket ship emojis promoting high-risk viral trends. The reality of these viral trends is that they almost always collapse, leaving retail investors holding assets that are effectively worthless. Steady, reliable investments in broad market funds or blue-chip companies generate actual wealth by ignoring the noise. Permanent financial losses are rarely caused by a broken market mechanism. They are almost exclusively the result of emotional user errors that interrupt the timeline and break the compounding engine. To protect your portfolio from your own human emotion, you can implement a maintenance protocol known as dollar cost averaging. This protocol operates by committing to invest the exact same amount of money, like $100, every single month on a strict schedule. You execute the trade completely ignoring whether the stock market is currently up, down, or trading sideways. Wealth building rewards patience and consistency. The ability to keep the engine running year after year generates far more value than trying to find the perfect moment to start or exit. If you found this breakdown helpful, hit the like button, subscribe to the channel, and share this guide with someone who needs to start their financial journey. Down in the comments, let me know exactly what asset you plan to buy with your first $100 investment. By executing that very first trade today, you permanently step out of the inflation trap, activate your compounding engine, and officially take control of your financial destiny.